The 4% rule refers to the Trinity study, and the Trinity study came out, I think, in the 1990s, if I remember correctly. And basically, it was 3 professors, and they thought it would be interesting to see how portfolios performed over 30-year periods of time. And what they did is they took 30 different start years that were backed up far enough that they could have a complete 30-year period to measure. And they measured what would happen to a portfolio depending on how it was using, again, index funds, depending on how that portfolio was constructed, everywhere from 100% stocks to 100% bonds with various percentages between working, so from 100% stocks to 80%, 20% bonds, 70-30 on down to where you wound up with 100% bonds. So they looked at those portfolios. They looked at various withdrawal rates running from, I want to say 2%, maybe as high as 10%. They looked at what would happen if you adjusted a given withdrawal rate to account for inflation, as opposed to not doing it. And they came up with some remarkable sets of data to show how these things affected the portfolio. And I'm pretty sure that they were not the ones who coined this 4% rule. And I'm not entirely comfortable with that terminology. I think the better way to look at it would be the 4% guideline. But somebody, and I think it was somebody in the media, noticed that if you had at least 50% stocks, or 50% stocks, 50% bonds, and you withdrew 4% a year, and you adjusted for inflation every year, which is a pretty high bar, that portfolio would last for 30 years in 96% of the time. Another way to say that is it failed only twice. Only in 2 start years did it fail. And whoever observed this said, that's a pretty impressive success rate, and that became what's commonly now called the 4% rule. So the 4% rule says that you can withdraw from a given portfolio 4% of its value each year, and you can adjust it for inflation, and it will last, and your portfolio will last for 30 years. So I look at it more as the 4% guideline because there's nothing that's guaranteed. There's a thing called sequence of return risk, which simply means if you retire and you happen to retire at the beginning of a long bear market and your portfolio gets damaged in those early years, it's going to be very difficult for it to survive for 30 years. I say on my blog and I say in my book, nobody should set any given withdrawal rate, 4% or anything else, and set it and forget it. You always want to be monitoring it. You always want to pay attention to it. Not just, by the way, to avoid the possibility that you might run out of money, and that's a pretty slim possibility if you're withdrawing 4% or less. But also, when you look at the Trinity study, you see something very interesting. When you withdraw at that 4% level, in the vast majority of times, at the end of 30 years, not only has the portfolio survived, it's grown to extraordinary proportions. So if you're not paying attention, yeah, you might run out of money, but there's even a bigger chance that you're not going to be able to enjoy the money your portfolio is providing. So withdrawal of 4% is a great target. It's a great way to think about whether you're ready to retire or not financially, but you got to pay attention.